The biggest impact the employers can make is on the loss prevention, the safety side. The cheapest accident is the one that never happens.
Welcome to the Self-Insurance Podcast brought to you by CRMBC. Every week, we're interviewing industry experts, restaurant operators, and brokers to talk about the world of workers' comp self-insurance in California. Today, we're joined by Mark Walls, the Vice President of Client Engagement at Safety National. Welcome, Mark. It's so great to have you on.
Thank you for having me.
So, Mark, you have been in work comp for a minute.
Yeah, I've been in the workers' comp industry for over 30 years. I started with May department stores and was part of their self-insured, self-administered workers' compensation team. And after 20 years on the claims side, I moved over into my current role at Safety National, where I oversee client engagement and communications and am part of the government affairs team.
We are going to talk today about the big picture of workers' compensation and basically what the data tells us a little bit about workers' comp, but we're going to talk about the real picture of what is workers' comp. Tell me why that is an important thing for us to talk about today.
You know, let's start out with the data. People always like to look at the data to understand what's going on with certain lines of insurance. And that's a very difficult thing to do with workers' compensation because there's no one single source for information. You've got the NCCI, which collects data from 20-some states. Then you've got the independent bureau states like California's WCRIB and New York and some others that are separate. Then you've got the self-insureds who don't report their data into any of these bureaus. And each of those segments makes up about 1/3 of the total market. So it's really tough to look at the big picture of what's happening in workers' compensation because of that segmentation of data. So you've always got to take a step back and say, well, this is what it's showing, but what's the data source behind it?
Tell us a little bit more about Safety National and your role within Safety National.
So Safety National is a commercial casualty insurer and reinsurer. We are actually the largest and longest provider of self-insured excess workers' compensation coverage. Our workers' compensation is our main focus product line. We've been doing this for 80-some years. While we may not be a household name, we're big in the industry. We insure about 1 out of 13 workers in America.
And for anyone who's not familiar with what excess means, can you define that quickly?
So yeah, in the self-insurance world, you have excess workers' compensation policy. So it's a policy designed to cover catastrophic losses above a certain retention for self-insured employers and groups. Our policy will attach at claims that exceed $1 million. So we deal with the big, nasty claims.
And obviously, CRMBC is based in California, and you are national. So you have data from across the country. But obviously, we only look at California. What insight can you give about why our costs are so much higher in California?
So in every measure you look, California workers' compensation costs are higher than any other state in the country, and dramatically higher, not just a little bit, dramatically higher. And when you really drill into the reason why, it boils down to CT claims, continuous trauma claims. And basically what a continuous trauma claim is in California, you are allowed to file a claim saying, over time, I sustained an injury and that's somehow related to my employment. Well, this is the normal aging process. As we age, our body deteriorates. That's normal and natural. And what we've done in California is make that a workers' compensation claim. So if you're on your feet all day long and you weigh 400 pounds and your knees hurt, suddenly that's a workers' compensation claim. And so what you've done here is shift what should be covered under the healthcare system into the workers' compensation system. And when you look at the numbers out of California, it's staggering. 38% of the total claims and half of the litigated claims are these CT claims. And they just don't exist in other states. So that's an element that you've added into the system in California that employers in other states just don't have to deal with.
It's one of the most maddening things, and we're always working with lobbyists and groups to try to do something about it. But as you know, California is a challenge. Speaking of which, California just raised minimum wage for certain employers to $20 an hour. Can you tell us, based on the research that you've looked at, how do you see that impacting work comp in California?
Well, workers' compensation premiums are typically tied to payroll. So if the employer's payroll goes up, the workers' compensation premiums are going to go up. That'll be caught during the premium audit that's done at the expiration of the term. So for employers out there that have had to increase their wages, if your total payroll is going up, expect that your workers' compensation premiums will go up at audit because of that increase in the payroll.
And because we're going to be paying out the temporary disability at a higher rate.
Oh, everything just builds upon itself. Higher rates for claims, higher payrolls. It just builds upon itself.
So we talked about how long you've been in work comp. You've been on the TPA side. Now you're on this side. You've been in the marketing side. Based on all of your broad knowledge and experience, what do you think are like the top things that employers can do to manage their work comp costs?
The biggest impact the employers can make is on the loss prevention, the safety side. The cheapest accident is the one that never happens. And once an accident occurs, you really lose a degree of control over things. So the best approach employers have is really emphasizing a strong safety culture, that accident prevention, training your associates. You just cannot cut corners when it comes to safety and training your workforce on safe working conditions.
And one of the things that we're hyper focused on at CRMBC is a crossover in the analysis between our underwriting and our claims and our loss prevention, because we've noticed that a lot of times these two departments work in silos and they're not talking to each other, which really defeats the whole purpose. When you see trends in, look, there's lots of slips, trips, and falls over in this operation over here, we need to do something about that, instead of the loss prevention programs that just make sure that you have eye wash stations or, they're not speaking to each other. Have you seen, in your experience, have you seen groups that are just nailing it and doing a really good job on that?
I've seen people challenged with it, and I've seen people that do it well. And you hit the nail on the head. When you do it well, you integrate those things. Your safety loss control people are working in lockstep with your underwriters and your claims people to identify trends and go out and solve the problem so that it doesn't continue to be a trend. Where it doesn't work is where you have employers where safety and loss control is on the operations side and workers' compensation's under HR or finance. And as you say, they're in different silos. They don't talk to each other. So the key is having that integrated model like you described, where your safety and your underwriting and your claims people are working closely together.
And when you're talking about loss prevention, one of the keys to that is avoiding catastrophic claims. And that's what Safety National focuses on, is the coverage for catastrophic claims. Let's talk about that a little bit. Over the lifetime of CRMBC, we've been around for over 21 years. We've had a handful of them. Not many, but a handful of them. So obviously, we're only restaurant and food service. First, can you just give us big picture? Which industries are the biggest culprits for having claims that pierce the excess?
The higher hazard industries tend to have more catastrophic injury claims, as you can imagine. So construction, public entity with first responders like police and firefighters, they tend to have more of these claims. But the reality is these types of injuries can happen in any industry. We've seen them from the simplest things. The most common elements are car accidents, falls. A simple fall. Somebody trips and falls and they hit their head wrong and you could have a brain injury. And it's as simple as that. A person falls and lands wrong and hurts their spinal cord or suffers a brain injury, and suddenly you have a catastrophic claim. So it can truly happen in any industry.
Can you tell us some war stories of how big these claims can get?
Well, there's been some studies around this that show that these catastrophic injury claims are less than 5%, less than 0.5% of the total, but make up close to 20% of the total costs. Now, those studies were done by NCCI and looked at data that was 10 years old. We track development on our claims out 50 years. So they don't stop developing at 10 years. These catastrophic injury claims go on for a long time. The biggest claim that we've heard of in the industry was about $40 million. That was
Wow.
a multiple worker severe burn claim. Wasn't one of ours, but that's the biggest one we've heard of. On our end, what we're seeing is the big claims are getting not bigger, and we're also seeing more of the big claims. And really what's driving that is a few things. It starts with medical advances. Medical technology, it keeps advancing. We see it all the time, all the incredible things medical science can do, but that comes at a cost. Accident survivability for severe injuries is up dramatically over the last 10 to 15 years, which means the care at the scene, the use of air ambulances, the care that they receive at level 1 trauma centers, people are living that used to die. But those then turn into very expensive multi-million-dollar claims. The other thing that we're seeing is for these severely injured workers, the medical science has gotten much better at preventing the types of complications that would severely restrict life expectancies. And so people with these severe injuries are living much longer. So what does that mean? 20 years ago, somebody that had a severe spinal cord injury, say a quadriplegic, their life expectancy was usually less than 10 years. Now that person could live a near normal life expectancy. So think of that. Somebody in their 20s suffers an injury like that. They could live another 30, 40, 50 years, all while requiring round-the-clock attendant care and home health aides and things like that. So what we've seen in our data is over the last 6 years, we've seen a 91% increase in claims that are 2 million above the self-insured retention. So that is, our clients are retaining an average of $1 million, and we're seeing a 91% increase in claims that are 2 million above that 1 million. Over that same period of time, we've seen a 183% increase in claims with an incurred over $10 million. So
Wow.
these big claims are getting much bigger, and we're seeing more of them really tied to accident survivability.
Is there also an increase in the frequency that you're seeing?
There's an increase in the number of these big claims just because people are surviving the accidents. So overall accident frequency has been flat to trending down. But for these big claims, because the medical is doing such a better job saving lives, we're seeing more of these big claims just because of people surviving what would have been a fatal accident 10 years ago.
And so on the one hand, we all agree that that's a great thing, that people are surviving. And then in the reality of being a carrier and being a self-insured group, what do you think is the solution? What needs to happen here? Is this sustainable?
It's reality. You've seen for a number of years, workers' compensation really has been viewed as the stable casualty line. Businesses are seeing their property and liability and auto insurance rates skyrocket while work comp's been fairly stable. This long tail of workers' compensation, these big claims that are going to be open another 30, 40, 50 years, those are in the system. Sooner or later, those rates are going to have to adjust to account for those claims that are continuing to develop over time.
Yeah, that's going to be an interesting phenomenon that we're going to have to track and see, because it's really affecting your level, the excess carrier. But then that, just like the higher minimum wage, there's a steamrolling effect. There's going to be impacts to the carrier, impacts to the self-insured employer as well, even if they're not seeing it today.
Yeah, absolutely. And, it doesn't matter that you've never had claims like this. The way insurance works is you spread the risk. As an insurance carrier, when we're pricing business, you look at the history of the insured and their loss history, but we also have to look at what's happening in our book of claims. If the cost of our book of claims is going up, then we have to adjust our premiums accordingly. It's no different than you see on the personal line side. Your homeowners goes up, your auto goes up, whether you have claims or not. And that's because the cost of the claims that the carrier is paying across the system is going up, and they've got to collect enough premiums to do that.
We talked about work comp as a whole, but can you talk a little bit about restaurants specifically, what you see, whether it's across the country or specifically to California, in terms of what kind of claims? We talked about just falling, but is there more data or more insight you can give us for specifically to benefit restaurant owners?
For our restaurant clients, slip falls are always one of the biggest and usually the highest severity claims. Cuts are another one that are fairly common in restaurants. Usually those aren't a high severity claim, but they're a high frequency claim. And it's something that, there's a lot of attention given to. Both of those, there's a lot of attention given to on the loss prevention side. There are tools you can use to help cut down on knife injuries, surfaces you can put down, shoes you can wear that really cut down on slip and falls and things like that. So those are the two areas where we see the most accidents in the restaurant industry. I will tell you, though, a trend that is really alarming that we see, and not just in the restaurant, but in any industry that deals with the general public, is workplace violence. We're seeing that become more and more of an issue in many industries, restaurants, retail, K through 12 schools, just people who are assaulted by the general public for whatever reason. I'm sure your members have seen this. It's something that they've experienced, and that is really difficult from the loss prevention side because you interact with the general public. There's no way to stop that from happening.
And in California, there's a new regulation that is requiring a workplace violence policy to be added to the handbook and actually be handed out to all the employees. That's how big this has become. The people we talk to are saying that most of that got worse during COVID.
We've definitely seen that increase. I mean, I don't want to use COVID as an excuse for people behaving badly. Honestly, I think what it tracks down to is one of the things that went along with COVID was emptying prisons. So you see the same people committing the same crimes over and over again, and that includes assaulting employees in the workplace. When people aren't put in jail, when they don't face repercussions, they keep doing this. And that's really what we see is a lot of times it's repeat offenders. You will have restaurant clients that'll say, this person comes in here every couple of weeks and harasses our employees, and we call the cops and they haul him away when he's back in 2 weeks doing the same thing again.
Yeah, it's unfortunate. Thank you, Mark. I want to end on a high note because we just ended on talking something not high, not fun. Tell me a good success story from your years of working at Safety National.
I will tell you, having worked so long on the self-insurance side, I just want to emphasize the value that self-insurance provides. I mean, you start with the premise that these are your workers and your dollars. And when that's your foundation to how you approach everything, it changes the game. You want your injured workers to get the best possible care. You want them to get back to work as possible. You're very mindful of the dollars because these are your dollars out of your pocket. These aren't just some carrier's dollars. So self-insurance really does provide employers with a tremendous opportunity to see cost savings, to get better outcomes on their claims for their injured workers, and also just to be more involved with the claims. When you are part of a first dollar coverage and you just write a check and send it off, you have no influence at all in anything that goes on with those claims. And it's, as an employer, you care for your injured workers. You want to make sure they're getting the best possible care and that the opportunity is there to get them back to work as quickly as possible. And self-insured groups like yours provide those tremendous opportunities for a more positive outcome on these workers' compensation injuries.
This is what my conversation is 8 hours a day, is talking to employers that are on the fence about whether to go self-insured. And we love brokers. We work with a ton of brokers, and some of them really get it and speak the language that you're speaking. And then I've got a bunch of other brokers that are in the ear of the employers saying, it's too dangerous, it's too risky, and things like that. What do you have to say in response to those kinds of comments?
Well, there's a couple of things going on there. One is your pool is very financially strong. You're very transparent with your numbers. Everyone sees what's there. I don't see that well-run pools are any riskier than the general carrier community. One of the dirty little things is follow the money. There are agents out there getting paid commissions from carriers, and sometimes those carriers are paying higher commissions than they're going to get through other sources. And so they may be putting their own self-interests ahead of the interests of their client. And that's a shame, but it does happen.
Well, Mark, thank you so much for being here today. I really appreciate our conversation, and I look forward to having you back on again sometime in the future.
Thank you so much.
You too. Thank you for joining us for the Self-Insurance Podcast, brought to you by CRMBC. If there's a topic you'd like to learn more about, or if you have any questions, just email us at info@crmbc.com. Remember to subscribe, like, comment, and share, and join us again next week for more tips on self-insurance.